The year is 2007. The S&P 500 doubled in price in 5 years. The Federal Reserve is about to cut the rates. Everyone is bullish and anticipates new all-time highs for the equities. And then, bang, equities tumble at first and then go into freefall as the economic turmoil continues. In hindsight, there were dozens of leading indicators that were screaming a recession. But why did investors fail to notice those? Perhaps because of behavioral biases that are driven by human nature. Similar to the 2007 scenario, the S&P 500 rallied by 60% in the last 2 years. The Federal Reserve is about to cut the rates this month. Everyone is bullish on equities and the market doesn't price in a recession. Are there leading indicators that scream a recession like in 2007? Yes, there are many of those. During the Jackson Hole Economic Symposium, Jerome Powell publicly advertised that they would cut the rates in September. The only question left is whether they will cut by 25 or 50 basis points. According to the CME Fed Watch Tool, the probability of a 25 basis points cut is 59%, while the probability of a 50 basis points cut is 41%. So there is no consensus among investors. Hi everyone, my name is Ruben and today we will look at various leading indicators that hint to us that serious cracks are opening up in the US economy. We have covered the most prominent household, business, and labor indicators in the prior parts of this series, which you can find in the description of this video. In part 4, we will concentrate on the general macro indicators that have a high success rate of predicting economic downturns. Fasten your seatbelts and let's get started. The first chart that we will look at today is the yield curve, specifically the spread between 10 and 2-year US Treasuries. If you follow the news, you will know that the yield curve is about to uninvert. The spread has actually become positive for a few days and now sits just below zero. If you didn't get what I've just said, don't worry, we've got you covered. For starters, bond prices and yield are inversely correlated. In simple terms, it means that when bond prices go up, the yield goes down, and vice versa. Now that we understand this inverse relationship, let's see what does an inverted yield curve mean. For that, we need to start with a normal yield curve. We depict yields on the vertical axis and bond maturities on the horizontal axis. Usually, the longer the maturity, the higher the yield on a bond. This is simply because investors take on more risk for longer-term bonds than they do for shorter-term ones. In finance, that extra reward is called a maturity risk premium. However, there are some rare periods when the yield on shorter-term bonds is higher than that of the longer-term bonds. That's when we say the yield curve is inverted. As you can see in the right chart, the shorter the maturity, the higher the yield. This is not normal, and this should not be the case in a healthy and efficient economy. Now let's go from theory to real life. This is the yield curve as of September 2024. You see that the highest yield is provided by the shortest maturity bond. Another crucial thing that is sometimes overlooked is that the Federal Reserve has direct control only over the short-term rates. So the yields on the long-term treasuries, say 10-year bonds, are determined by the market. Historically, there were periods when the Federal Reserve directly controlled the long-term rates as well, called yield curve control. However, they haven't employed that tool in recent decades. Now that we covered the basics of yield curves, we can differentiate the two types of uninversion, bull steepener and bear steepener. Let's start with the bull steepener. Here we have the inverted yield curve. In the case of a bull steepener, upon the uninversion, the yields on the short-term bonds go down more than for the long-term bonds. The red curve is already uninverted as the yield is higher for longer-term bonds. Now let's jump into the bear steepener. Again, we have the inverted yield curve in black. And in the case of a bear steepener, upon the uninversion, the yields on the longer term bonds increase more than for the shorter term bonds. The red curve is the outcome, and it indicates a normal yield curve. By looking at this, you might have already guessed that we are going to have a bull steepener. This is simply because the Federal Reserve will start its rate cutting cycle in September, and the yield on 2-year notes will most likely drop more than the yield on 10-year bonds. As the name suggests, the bull steepener is bullish both for equities and bonds. Coming back to the yield curve, or the spread between 10 and 2-year Treasury notes, we see that the spread is very close to 0%, and it is about to uninvert. Another thing that we might notice is that usually recessions follow the uninversions. So it is not the inversion that signals a recession, it is the uninversion. Does this mean that a recession is guaranteed? Absolutely not. Does this mean a recession is possible or even likely? Yes. Next up, we have the chart of the probability of US recession predicted by Treasury spread 12 months ahead. It takes into account the spread between 10-year and 3-month treasuries. As can be seen, this indicator has been very accurate in prior recessions. Currently, the probability of a recession in August 2025 is at around 62%. However, as this indicator predicts the probability of a recession 12 months ahead, we should look at the probability of a recession predicted a year ago. Lo and behold, the probability of a recession in Q4 of this year, predicted last October, is about 70%. This is more significant than you might think. Every time the probability was this high, a recession followed. In fact, a recession materialized every time this probability was higher than 40%. However, as any economic indicator, this is not perfect. There were a few occasions when it spiked but a recession didn't materialize. The only difference is that those spikes were well below 70%. The next indicator in our arsenal is the M2 money supply growth rate. Contrary to other indicators, we have data for more than 100 years for this one. The purple line is the 0% growth rate of the M2 money supply. As can immediately be seen, the growth rate of the money supply was positive for many decades, from the late 1930s to the late 2010s. The growth rate plummeted from 27% in 2021 to negative 5% in 2022. Surprisingly, this was the first time that the money supply contracted since the Great Depression. The money supply didn't contract for 9 decades and then contracted by 5%. Contrary to the mainstream argument that this is because of the 40% increase in the M2 money supply after the pandemic, it would be prudent to remind ourselves that it is not the absolute value that matters, it is the rate of change. Therefore, the 40% increase in the money supply was the main factor in this contraction. However, the rate of change, that is, the growth rate of the money supply, is the most important thing. At the end of the day, the M2 money supply contracted, and it contracted big, so neglecting this would not be wise. The terrifying part of this chart is when you realize that in the last 150 years, it went negative only 4 times if we exclude the recent one. You will be even more terrified when you look at those 4 instances when the money supply contracted. Those were the 3 depressions, including the Great Depression, and the Panic of 1893. It's needless to say that you would prefer not to be invested in equities on these occasions. To add insult to injury, the rate of the recent contraction of the money supply was the second highest. The only time in the last 150 years that the money supply contracted faster was during the Great Depression. Therefore, ignore this chart at your peril. Last but not least, we have the federal funds effective rate. People assume that when the Federal Reserve cuts in September, it will be bullish for the markets. However, they might need to look at this chart twice. Usually, when the Federal Reserve cuts rates, a recession follows. We can see it with the naked eye. However, we can also utilize a few statistical tools that measure the indicator's performance and accuracy. For that, we need to gather the number of true positives, false positives, and false negatives of this indicator. We have 10 true positives, which means that the Federal Reserve cut rates substantially and the recession followed 10 times. For these calculations, you can include or exclude the pandemic recession based on your judgment. We included it because there were numerous signs that the US economy was weak and was close to a recession, and we suspect that a recession would materialize irrespective of the pandemic. The pandemic only magnified it and made things worse. To continue the calculations, there have been only two false positives, meaning that the Federal Reserve cut rates substantially, but the recession didn't materialize. And lastly, there are no false negatives, meaning that all recessions occurred during or after rate cuts. Now that we have the inputs, we can compute the precision, recall, and F1 score of this indicator as a recession predictor. The precision is about 83%. The recall is impressively equal to 100%, and the F1 score, which is the harmonic mean of the other two measures, equals 91%. All three measures are very impressive and indicate yet again that a recession is not only possible but likely. In sum, then, the general macroeconomic indicators do not suggest anything good. Not only the rate cut is not bullish for the markets, but it is usually the start of a recession. When you couple today's indicators with the indicators that we covered in prior parts, you get a high probability of an economic contraction, which will probably be accompanied by the poor performance of risk assets, including equities and cryptocurrencies. Make no mistake, this doesn't mean that the next bull run is far from us. We predict that the potential recession will last for only a few weeks or months. The United States cannot afford to be in a lengthy recession. They will print their way out of it by announcing another massive round of quantitative easing, and at that time, risk assets will bounce back stronger than ever. Liquidity will flow into safe assets first, but at the blow of top phase, it will find itself in more risky assets, such as small cap equities and altcoins. Between now and then, however, we might experience some volatility, which could create a generational opportunity to buy at low prices before the money printer is turned on again. As always, thank you for watching. Stay rational and data driven, and I'll see you next time.